Hey, Steve Saretsky here. As always, this is the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. Obviously, a lot going on in financial markets right now. Basically, everywhere I turn, there is something happening. And this is why when I talk about Vancouver and Canadian real estate, that when I say you can't look at it from a micro context, we have to look around and see what is happening in capital markets to understand that there's some sort of underlying theme here. You can see that in FANG tech stocks. I think Facebook's down 40% from peak, but they basically all those FANG stocks in bear markets. Oil has been in the dumps lately, particularly Western Canadian Select that is hitting Alberta extremely hard. Despite that, the Bank of Canada is still bullish in the rate path. You have obviously Bitcoin. I mean, that's everybody knows that's been taking a beating, continues to move lower. So there's clearly some volatility happening in financial markets, and that ultimately correlates to what we're seeing in Vancouver and in Canada, which is obviously a leveraged asset dependent on interest rates. And what you have is basically this shrinking of global liquidity, and it's really starting to disrupt financial markets. So again, with the Federal Reserve, tapering off their balance sheet, hiking interest rates, the Bank of Canada trying to follow suit. We do have there's undoubtedly a lot of leverage in the system, and so that's starting to disrupt multiple asset classes. So very important to watch moving forward, obviously. But not to be too negative or pessimistic. You always just try to understand where we are in the cycle. Be realistic about it, and then you try to make the decisions off that. So this is all channel again has always been about financial education, and with that, perhaps on a more positive note, sometimes we talk about what I'm reading. Mastering the Market Cycle by Howard Marks. This has been a huge thought driver and decision maker for me, is reading a lot of Howard Marks' work. If you don't know who Howard Marks is, he runs a $120 billion hedge fund, extremely successful. He's got endorsements here from Charlie Munger, Warren Buffett, and Ray Dalio, so I think that speaks for itself. But Howard Marks is a brilliant writer, and he actually buys up a lot of distressed debt, real estate, that sort of thing. So he's one of those guys where he writes about in his book, and it's something that I strongly believe and that I want to emphasize in these videos, is that what he says is basically nobody knows what's going to happen in the markets. And I don't know what's going to happen tomorrow or 3 months or 1 year down the road, but what I can try to do, and to the best of one's ability, is he says you have to try to figure out where you are in the cycle. Where are you in the cycle, and then you sort of make and hedge your investments based on that strategy. What is the risk versus what is the reward, etc. And so his book really highlights that, things to look for in market cycles. Talks a lot about the real estate cycles, stock cycle, etc. But a brilliant book, and for anyone that let's call it a Christmas giveaway, I'm going to give away 2 of these books. Ship them to your door, just as a way as saying thank you for watching and supporting this channel. So if you want a book, Mastering the Market Cycle by Howard Marks, just comment below, let me know why you want it, and I'll just randomly pick 2 people, and I'll send you a book. So hopefully like Howard Marks is a better educator than I ever will be, probably. So hopefully someone gets some value out of that. Moving into Vancouver market in particular, the speculation tax, which has been long debated, got approved through legislation, and that is going to be implemented officially starting January 1st, 2019. So if you're not familiar with that, it's basically a 2% tax. If you're a foreigner, whether you're American or Chinese, doesn't really matter. But if you have a home here in Vancouver that's not your primary residence, and you don't rent it out for at least 6 months, you'll pay 2% annually on your tax assessed value. And then if you're sort of I believe if you're Canadian or like say not actually paying income taxes in BC, but you're Canadian, so say you're from Alberta, they readjusted that down to 0.5%. So basically, say if you live in Calgary and you have a home here in Vancouver that you don't rent out 6 months a year, you'll pay 0.5% of the tax assessed value. Now, I agree with it, disagree with it. I'm not going to get into the politics of that, but that is going forward January 1st. I think a lot of that sort of policy has really already been baked into Vancouver real estate, but I do think, and I know it's going to create some forced sales for sure. I can say it firsthand from my experience, feet on the ground, and from discussing with other realtors, that we are running into situations, it's not like frequent, but they are happening, where the home has been empty. It's for sale. They've been trying to sell it for 4 or 5 months, and they don't live here. They're foreigners, and they don't necessarily want to rent the house out because they're trying to sell it, etc. Where all of a sudden they're going to be much more inclined and open to taking a lowball offer because they need to move the home because they don't want to be subject to all these taxes. And so that is happening. I wouldn't say it's widespread, but obviously, when you have a seller like that, that is basically under some pressure and under some distress to sell, because that's a lot of taxation coming their way. That creates basically a forced sale, lowering the benchmark price, and that sort of sets your standard in certain neighborhoods, etc. So definitely be watching for that moving forward. I've mentioned a lot on Canadian debt. We've talked a lot recently on home equity lines of credit, how those have been growing quite a bit exponentially, not only funding the private lending space, but you can start to understand why OSFI has brought in more regulations to try to clamp down on that market. And if you look at it, you look at the big six bank balance sheets, home equity lines of credit now make up 17.5% of residential secured loans on their bank balance sheet. You can see that it actually bottomed in Q1 of 2017, and I think it started to climb a little bit afterwards, and it's still growing right now. And I think that's based on not only the amount of equity that they've seen increase over the last number of years that they're tapping into, but I think it's also partially related to some household indebtedness stress that's being induced from higher interest rates. If you can look at the effective borrowing rate in Canada, which is essentially the rate that most Canadians, your typical Canadian, is actually borrowing at. And so I believe it's just about 3.9%. It's actually up 32% from, I believe it was November 2016, where it officially bottomed and has been rising ever since then. So you have, Bank of Canada hiking interest rates, your cost of borrowing is rising, your debt service levels are rising, and that's why you're seeing a reduced equity in Canadian housing markets, because ultimately it's a leveraged asset, and when you start reducing new credit and borrowing capacity, it's going to push down on prices, and that's certainly what we're seeing. And of course that causes risks. That's why you're seeing all levels of government coming in and clamping down on this, whether that's through a speculation tax in BC or whether through its mortgage stress tests, home equity line of credit stress test, all that sort of stuff. Which really brings me to my next point, because we're seeing the Bank of Canada hike interest rates, and then quietly behind the scenes they actually introduced or announced that they will be adding on the ability to buy Canada mortgage bonds. So what this basically is effectively saying is they're not going to be buying Canada mortgage bonds today or tomorrow, or they're saying in the near future. But what the announcement does is it basically gives them the ability to buy the Canadian mortgage bonds, which in simpler terms, this is what it means. It means basically right now, today, there is a desire and an appetite from outside investors, whether it's pension funds or whatever, there's an appetite to buy Canada mortgage bonds. So there's no problem there. And Canada mortgage bonds ultimately create liquidity for banks to continue to lend. And so what they're saying is, with this policy, the way I read it, and through being able to talk to people that are actually involved in the banking sector, whether that's bond traders or hedge funds, etc. Thankfully, I can go to these guys, and they all gave me slightly different opinions. But the grand outcome of it was that, don't look at it today as they're going to start buying up all these Canada mortgage bonds, because they're not. What they're saying is basically, hey, if we run into a liquidity event, we want the ability to basically be able to step in and purchase these. That way, you can basically, it's basically a crisis preventer. It's a way to ensure that there's liquidity in the market, that rates don't get out of control, that banks don't have to basically freeze their lending. Bank of Canada basically clarified they're going to basically be able to purchase these. It's going to go to investors first, and if they hit their limit of $40 billion, which they have continued to do so, no problem. But if they don't, then the Bank of Canada will be there, and they will basically buy up Canada mortgage bonds. And I think if they buy Canada mortgage bonds, what's to stop them from buying, residential mortgage-backed securities after that? Now, they haven't implemented that or announced that, but that would be certainly an indicator that we would want to watch for moving forward. Is keep an eye on Bank of Canada's balance sheet, seeing what they're buying, seeing what the appetite is for these bonds, and that will tell you a lot about liquidity in the market. So an interesting development. It's just an odd time to announce that that you're going to allow yourself the ability to buy these bonds, because you're aggressively hiking interest rates, and you're seeing housing slow down and credit contract. So to me, it seems like they're maybe getting ahead of the curve here, just to make sure things are safe moving forward. But again, not to get into that, I wouldn't read too much into it, but I do think it's an interesting development. So again, we don't, whether it's bullish or bearish for the market, if I was bullish real estate, I would say, hey, great, these guys are going to try to backstop us, worst case scenario. So it's always just about providing the analysis and letting people decide for themselves. Next week we'll discuss the November numbers for Vancouver real estate. Getting a lot of questions about from reporters saying they're putting together some forecasting piece for 2019. You're starting to see all these forecasts coming out, and again, I would caution, as Howard Marks says in his book, on forecasts, but particularly who they're coming from. But we'll get into that next week. Quick touch on the pre-sale market. I've talked about this as a space that I think is very interesting to watch. We're seeing increasing incentives. Urban Analytics, which is a research development firm, was quoted as saying they have new condo prices down between 5 and 15%, depending on the sub-market, which is pretty much in line with what I'm seeing. I think that 15% is more so in the Valley in Langley, where you have condo inventory quadrupling, for example, and they're now beginning to price not above market value, but they're actually beginning to price at resale values. So you're starting to see the pre-sales prices come off, and you can see this. Here's a chart from Altus Group showing the unsold months of inventory for new condo inventory, and that's so year to date, January to the end of September, they have the months of inventory for new condo setting at 3.9 months of inventory, 3.9 months of inventory, versus the same time last year was only at 2.5, which again is historically low, but you can see that change of direction is something to take note of. And you can see that not only through that, but you'll see that we've had across Greater Vancouver, you've had inventory, resale inventory increasing, and then you've had the unsold inventory for new construction increasing. At the same time, you have a record number of new construction underway. So that is going to create this dynamic, I think, where we have much more supply than meets demand. But anyways, we'll leave that for another video. I hope that helped. Otherwise, see you next week.